Risk is never extinguished in finance, it just gets moved around. A large bid-offer spread between what people running large financial institutions thought they knew about the financial system and what was actually happening. But again, too much is taken for granted. The things that need to happen every day to keep the lights on, to settle transactions, to move money around, still require an enormous amount of human intervention. I was educating people. I soon became known as the plumbing guy, which is great. We've all been trained, brutally so, in 2008, that economic cycles are credit cycles.
Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
James Aitken is known as an expert in the plumbing of the financial system. Those skills, acquired largely while working for AIG, generated a unique client base for him in the global financial crisis and allowed him to set up Aitken Advisors, his global macro consultancy, whose clients include some of the world's largest and most influential investors. In this interview, you'll be relieved to hear James left his wrench at home. Instead, we went on a world tour looking at some of the hotspots in global finance. You'll learn why James is relaxed about the US. Spoiler, it involves nominal GDP growth. Why the Japanese government is likely to be successful in its program to make Japan great again. And why that could have serious repercussions for global bond markets. Why China will likely muddle through in spite of the massive problems in its property sector. And why investors should be paying close attention to Taiwanese politics. James operates his global business from his home in Wimbledon and spends a lot of time reading and thinking about the world. And boy, is that evident in this discussion. My intern, Ivan, who's looking to do PPE at Oxford, called it a masterclass in economics. James also has a pithy phrase for every occasion. Learn why you need to beware the stable variable, why people sleepwalk into events, and how he changed tack from financial plumbing because you can't always be the man with a hammer. James has a seriously thoughtful approach, and you can't fail to be a better investor after listening to him for an hour and a bit. I hope you enjoy this almost as much as I did.
James, I'm so excited to talk to you. Thank you for coming on the podcast. And just tell people a bit about yourself, because you're an expert in financial plumbing, and nobody ever set out in life with that as an ambition, I assume. And so talk a bit about how you got there, and maybe give us an example of the sorts of things you look at. Maybe look at something like LDI, because my listeners are equity people.
Yeah.
So they don't understand the complex stuff.
Yeah.
So,
well, I think they understand a lot of it very, very well, but Steve, it's nice to see you, and it's nice to come here to Paddington and have a conversation with you. And I've admired for a long time from a distance what you've been doing. It's terrific, and it stands in stark contrast with all the hair on fire commentary that seems to prevail these days and pollute LinkedIn and social media platforms. And I think what you're doing is commendable in the extreme.
Oh, thank you.
Because you're trying to educate people on what really matters.
Sure.
And I think that's invaluable. So it's lovely that we can have this conversation. And I know we've been back and forth for about 18 months, and here we are. Yes, I think you're right. No one sets out in life to be a financial plumber. If one ends up as a financial plumber, clearly one has failed at a whole range of things first. But there we are. But look, coming to the chase, I've always had a curiosity into how things work. I don't just mean financial system, I just mean everything. From when I used to drive my father mad when I used to try and take apart our train set and everything else, and there we are. But so this curiosity, innate curiosity into how things work, and combined with a huge passion for reading. My kids know me as a book with legs. But look, I'm not going to take you or our listeners through my whole lamentable sell-side career. But
go on, just a bit.
No, come on, no. How long have we got? No. But look, I ended up working at AIG Financial Products. And I turned up there thinking I knew a bit about how the world works. And of course I didn't. But the irony of working at AIG Financial Products is, of course, that the entity got into a lot of trouble. But it was also an opportunity for me to quietly learn about how things actually worked. Because AIG Financial Products touched every part of the financial system. And yes, it was hard to see it. And it was just an opportunity that presented itself. You could not have made it up. And I went from a pretty simple macro type of person, trying to figure out the direction of economies and interest rates and currencies, into this deep, deep world of structured credit, balance sheets, and basically everything that happens every day across the financial system to keep the lights on. So you're right, it was just a complete fluke, and I tried to make the most of that luck. And look, and then you skip ahead a couple of years, I'm at UBS. I mean, it's laughable, really. I'm on a foreign exchange sales desk from September 2006 onwards.
Oh, stop. What is there to sell in foreign exchange? You just take orders.
Oh, come on, that's so dispassionate. You sound like an equity man.
Okay. So you're predicting.
No.
You're predicting rates.
No, look, actually, we should, as they say in podcasts, we should double tap on that for the benefit of your audience. It's like foreign exchange sales or advisory in an investment bank today is very different to what it was. And the essence of foreign exchange trading for many, many decades was frankly information. Who's doing what? Who's doing what? How much? Where and why? What does it mean? Do I go with the flow? Do I reverse? All that kind of, it was information. And then it became progressively more sophisticated. And you had teams of traders executing often very, very large orders in currency markets, and you had a team of people managing the client relationships. And depending on the client, it could be like short-term advice, trading the next 5 minutes, this, that, and the other, or what I like to think was more sophisticated structural forces at work, slower moving capital. And unsurprisingly, given the way I'm constructed, I worked with slower moving capital. So I'm sitting on a foreign exchange desk, Steve, at UBS in London, working with, frankly, the most wonderful group of people. I mean, just as a sidebar, one of the great tragedies of 2008 is that UBS got into such trouble whilst there were so many world-class people working in various parts of UBS. It was a classic management failure. So I love working at UBS, and I was advising sovereign wealth fund CEOs and CIOs, macro hedge fund CEOs and CIOs, basically thoughtful, discretionary, risk-seeking investors who were trying to understand the world from a top-down macro perspective. Sure. And it's obviously a challenge when you try to connect with those people who are very no-nonsense. They don't suffer fools. But it's something we'll discuss later on. I know the way to connect with those types of people is by being brutally honest, because most people pander to them. So there I was, and I'm arriving on an institutional sales desk trying to print foreign exchange tickets, and I end up giving endless presentations on subprime and structured credit and help people get short subprime and help them understand what was happening in the financial system. So look, all I tried to do is make the very most of my luck. I was in a privileged position of being able to articulate and explain just what was happening under the surface of the financial system.
Because you'd seen the other side of it.
Yeah, I had, yeah. And the other thing was, I thought I knew a fair bit, having worked at AIG Financial Products, but been surrounded by extremely impressive people at UBS with expertise in repo and structured credit, all these fancy bits of the plumbing. That embellished my understanding, because I could say, hey, I think I know something, but I can walk over there and test if I'm actually thinking about it the right way, and then go to explain to investors around the world, and from late 2006 onwards, some of the most important financial policymakers on earth, just what was happening. So look, I made the most of it. I was educating people. I soon became known as the plumbing guy, which is great. And the upshot was, during a very, very difficult time for the financial system, I was able to help a lot of people not lose money, which was important. And I was able to help some people make an absolute fortune. And that was the start of what I do today. And to be clear, obviously I was working with a lot of risk-seeking investors and macro traders and credit types and bond people and rates. But I was also working with an awful lot of equity investors as well, who soon realized that there was, let's just say diplomatically, a large bid-offer spread between what people running large financial institutions thought they knew about the financial system and what was actually happening. It was quite shocking, the repeated management failures. I mean, not just at AIG, of course, but many other institutions. So an extraordinary time, an extraordinary experience. And look, you know what it's like. You can't always be the man with a hammer. If you're going to be useful to people for a long, long time, like any business, you have to evolve and adapt.
Sure.
I'm very happy to be always known as the plumbing guy, but you can't just be all about the plumbing all the time. So look, I guess we could summarize all of that as AIG Financial Products, baptism of fire, but tried to make the best of it.
And so you set up on your own in 2009
Yeah.
with the benefit of the tailwind from the global financial crisis. And
Yeah, and by the time I'd plucked up the courage to resign from UBS, the world had changed. The bottom was in. The fire brigade had arrived, central banks are printing money, fiscal policy at that time was all in, asset prices are going up. I mean, who cares about balance sheets, collateral, plumbing, it didn't matter anymore. And things were reflating, and I thought, oh, what the hell have I done? I've tapped out of a useful job. I've got 2 children with a third on the way. What have I done here? And my clients were absolutely fantastic. They said, don't worry about it, because finally we're able to pay you, now you're working on your own, for everything you've done over the previous 3 years. Get after it, you're good, we've got you. And I'm like, wow, how good's that? But then I got lucky again, because along came the Greek crisis, which was entirely contrived in November 2009. And Steve, amongst many things I studied at AIG Financial Products in 2005 was Greek sovereign exposures, peripheral debt exposures across Europe, all the derivatives that connected them together and so forth. I'd studied all of that. And I knew, without getting too technical, I knew if for any reason the haircuts, if you will, let alone the spreads, on any peripheral sovereign credit in Europe went out in terms of spread, or the haircuts increased, we would have another enormous systemic problem. And Germany and the finance minister at the time, Wolfgang Schäuble, everyone knew that Greece had been fudging the numbers for the best part of a decade, right? Everyone knew. And then the new prime minister came in, Papandreou, and said, look, sorry, ladies and gentlemen, our budget deficit is twice what we said. And Wolfgang Schäuble says, right, for the sake of European unity, we must teach Greece a lesson. And that was the trigger for, frankly, 2.5 years of rolling crisis. And once again, I was one of the few people able to say, look, I know this. It's not actually about Greece. It's about all of EMU. And here's what you need to look out for. And my client base over that period, without any website, any public profile, tripled via word of mouth. So
Wow, that's amazing.
So I was very lucky indeed. And then, of course, if we go further down the road, Mr. Draghi talks about bumblebees in London and whatever it takes. And then that's the end of that. So you have to go off and learn new skills to make yourself relevant to your clients. So there we are. So look, again, if people want to call me the plumbing guy, that's fantastic. It's always going to be something of immense importance to me. I would say even today that too much of how our financial system functions is taken for granted. Now, to be clear, that's nothing to worry about. It functions by and large pretty well. But again, too much is taken for granted. The things that need to happen every day to keep the lights on, to settle transactions, to move money around, still require an enormous amount of human intervention. And somehow it all works.
But the thing is, people need people like you, because when you've got Russia and SWIFT,
Oh, sure.
and
Yeah.
well, what is it? And so all these things only matter when something bad happens.
That's it. I think that's the essence of finance, isn't it? Oh, don't worry about that. Don't worry about that. Don't worry about it. Oh my gosh, this is really important. People sort of sleepwalk into events. But yes, it's constantly updating your priors. But you remind me there's an important point. It's very generous of people to suggest I'm a plumbing expert. I'm not sure there's any such thing. If people think I'm a plumbing expert, it's only because I have a relentless curiosity. It goes back to what we said at the top, a relentless curiosity into how things work. Are we sure about that? Now walk me through this. And I have around me a network of, in some cases, retired friends of mine who had enormously important roles over years on repo desks or collateral management, all this stuff over the years. So I can check with them if I'm thinking about stuff the right way. And I still have great friends deep within financial institutions who can help clear the fog if I'm asking questions about various regulatory reforms and this, that, and the other. So it's an iterative process where you're constantly updating your priors. You're constantly asking questions just to make sure you're thinking about things the right way. No different to investing, is it? Right? You're constantly updating your priors. You're never complacent, just to check things are all right. But again, you've got this cottage industry these days, I note, that whenever they're discussing the plumbing of the financial system or how things work, it's nearly always from the perspective of what's going wrong, what's going to blow up, oh, look at this, that, and the other. And most of it is just complete nonsense. It's complete nonsense.
So listen, let's go around the world
Yeah.
and talk about your views. And where should we start? Should we start with America? Because I was interested, your comment about, well, we've got 7% nominal GDP, so everything's going to be okay, because at that sort of rate of growth, you're not going to have a huge number of credit defaults. I was slightly upset about this, because I was kind of thinking that, interest rates going up, we were going to see some real problems.
Yeah.
And I've been thinking, what the next shoe to drop is like private equity, because there's all those companies with very, very high leverage.
Look, it's the same when we think about this extraordinary tightening cycle that we're on. I'm not sure it's fully complete, but we're on a tightening cycle. I'm with you, Steve. If we'd been recording this in January 2022, and we'd figured out that by the end of 2023, the Fed would have jammed up rates, the Bank of England, we go down the list, they've all jammed up rates, and we'd have a Fed funds rate at, let's say, 5.25%, give or take, etc. And we go around with this. Quite frankly, based on our experiences over the last 20 years, we would have said, oh, something's probably broken by then, something's gone really wrong, the central banks are in retreat, the usual grand old Duke of York, we march interest rates up to the top of the hill and then we march them down again, and around we go, because that described most of the past 20 years. And it's no different to the conversation we had about the plumbing. You're constantly updating your priors, questioning whether you're thinking about things the right way. Because so much of the past 2 years, I think, have not been about what has happened, but frankly, what has not.
Absolutely.
Right? And that's the essence of your question. We would have penciled in rising defaults by now, tighter financial conditions, much weaker earnings, lower stock price. We could go down the usual list. credit crunch, consumption crunch. It hasn't really happened. And that's for me been for 15 months saying, okay, what am I missing? What am I missing? What am I missing? What am I missing? So let's think a little bit about that using the US example, but I think a lot of what I'm about to discuss applies to other countries as well. We've all been trained, brutally so, in 2008, that economic cycles are credit cycles, right? Okay, there's definitely something to that. What's so different, I think, one of the many things that are different this time round, it's not a credit cycle yet, it's an income cycle. Now, we did something in COVID that we'd all been told was impossible. We did direct fiscal transfers to households and businesses, right? Furloughs, helicopter drops to household. We were told it was impossible. We did it everywhere. And macroeconomics 101 tells you that if the fiscal authority, the government, borrows a lot of money, hands the money to households and businesses, well, obviously it boosts disposable income for households and businesses. It improves their balance sheets. It allows them to de-lever. And in the case of US households, they were very early to realise that inflation was not transitory. They termed out their 30-year mortgages at very low rates, and right now they're feeling pretty clever. Same with corporations. Corporations were smart enough to not look a gift horse in the mouth. The best ones all termed out their funding. So the point here is there's no denying that the Fed's tried to jack up rates and tighten monetary policy and slow aggregate demand. But the pass-through, because household balance sheets and corporate balance sheets in the US in aggregate are still in really good shape, and the labour market is tight, so incomes in aggregate are rising, the pass-through from a notionally inflation-busting Fed with much higher rates is lower, is a lot lower than we've seen in previous cycles, because balance sheets are in great shape. That's, I think, the primary transition, and I think it's befuddled a lot of people. And of course, the simple other point which is related is that there are three important borrowers in any economy. There's two private sector borrowers, households and corporations, and then there's one gigantic public sector borrower, which is Uncle Sam or His Majesty, I should say, the Treasury, etc., the Debt Management Office and others we can mention. So two types of borrowers in the economy termed out their funding and improved their balance sheets, and unfortunately, the biggest borrower of them all, government, did not. We missed a massive opportunity, particularly in this country. If the market is desperate for long duration bonds, let them have as many as they want. That was the big, big miss in the US and especially here. And we're paying for that now. So unsurprisingly, as the cycle rolls on, and the US in particular has to borrow a fearful amount of money, the market clearing price on long duration US government bonds is lower. And the coupon that investors demand to underwrite that issuance is higher. And that process is far from completed and no bonds are bounced a bit. So look, a couple of key points. Household and corporate balance sheets in aggregate, particularly in the US, great shape. Uncle Sam, bad shape. And then we have a lot of borrowing for a long time to come. We have lost the price insensitive buyers of treasuries. For 25 years, we haven't had to worry about demand for government bonds. We had global sovereign wealth funds, we had reserve managers, we had central banks, and not least the Fed. Indiscriminate buyers of treasuries for a long, long time. They're not there anymore. I mean, they're dabbling, but they're not there. So we're trying to find out who the next indiscriminate buyer of government bonds is in the US and elsewhere. And if the answer is households, well, when they look at government dysfunction, they're probably going to demand a higher yield to come. But that's all to be resolved over the next couple of years. But on a broad macroeconomic point, I'll just finish with this. The US has a particularly perilous fiscal situation. I think everyone knows that. But to be running what's called a full employment budget deficit of 7.5% to 8% is nuts. And full employment budget deficit, round about now, when you're at peak employment, give or take, and the economy is doing well, tax revenues should be roofing it, transfers should be declining, your budget deficit ought to be stabilizing and falling, and the opposite is happening. And I can't imagine that whoever wins the election next year in the United States is going to be for fiscal austerity. That's the problem. But then here's the rub, which ties everything together. I keep saying macroeconomics 101 because, frankly, I don't think too much of this is complicated. Macroeconomics 101 would suggest that if any country, anywhere, is going to run a very large budget deficit, guess what? Nominal GDP is going to be high. And we'll come to that in a sec. Nominal GDP is going to be high. I say to my clients, I know everyone's excited about landings and economic landings and so forth, but to my simplistic way of thinking, if you're running a budget deficit that big, there can be no landing because nominal GDP is still going to be quite strong. And then for investors, and this is where people have struggled, if nominal GDP is going to be 5%, let's just pick a number in the United States. So it's come down a little bit from the extraordinary third quarter. If nominal GDP is going to be 5%, bills get paid. The economy as a whole is going to be generating enough cash flow to service all its borrowings. The cycle can continue. And frankly, in an environment of nominal GDP of around about 5%, which is above what we saw in the US for 20 odd years, and we can come to that if you like, guess what? The best run businesses will continue to find a way to generate sustainable earnings, defend their moats, and perhaps surprise markets with the resilience of their business, which is kind of what we're seeing.
And if we've got nominal GDP continuing at 5%, then the 10-year goes to 5%, stays at 5%.
Yeah.
But the 30-year...
Pick a higher number. Yeah, yeah. But let's think about that.
But that's got quite a lot of ramifications, right? Because if you're talking, say, 7% on the 30-year, why should anybody take risk?
Let's set aside for a moment the obvious conundrum that we're going to face for many years to come, which is US in particular debt sustainability, because the cost of the interest on all this borrowing from Uncle Sam is probably going to go up. So we know that, but let's just set that aside for a moment because that may take years to reach some kind of final reckoning.
Why though?
Well,
we'll come back to that.
We'll come back to that. But your point about nominal GDP, let's just flesh that out a bit. And we'll go with the US example, but it applies in other countries as well. So from 1995 till about 2019, nominal GDP in the United States was about 4. Inflation was about 2, which meant that you had real GDP of about 2. And obviously a colossal undershoot in 2008, as we all painfully remember. But Steve, if you've got nominal GDP for a number of reasons tends to peak around 4%, it kind of makes sense that a 10-year treasury runs out of steam at 4%, or at least acts as a handbrake on growth. And there was a rule of thumb 45 years ago, and I worked with some of these people who used to be on the Salomon Brothers bond trading desk in New York. And they were working with this chap, John Merriweather, and they had this famous economist, Dr. Henry Kaufman, who's still alive, and his books are amazing. And their rule of thumb, it's not like a point estimate, it's not day to day, but their rule of thumb is that through the cycle in the US, a 10-year note, 10-year bond, the yield ought to converge with nominal GDP, which is what you're asking. And I think it's an important point. So we've grown and learned and managed capital in a 25-year environment of lowish growth, lowish inflation, where people have rationally focused on real GDP. But one of the lessons from the 70s and 80s is that when you have a bit more inflation, okay, it's coming down, but it's still too high. What you actually should focus on is nominal GDP as a metaphor for aggregate demand. And the point is this. If we or any of our listeners said, oh my gosh, 10-year Treasury is going to 5.5%, 6%, most people would be inclined to pull out a tinfoil hat, hunker down. It's going to be dreadful for stocks, dreadful for this, that, and the other. Here we go. Well, like everything in finance, it depends. It depends. It's like these rate hikes. It depends. If you're jamming up rates because you're way behind the curve in fighting inflation, that's a shock. But if you're jamming up rates to do the bare minimum of monetary tightening, which I think central banks have, that's a thing altogether. But the point is this. If US nominal GDP is still somewhere between 5 and 6%, it is absolutely sensible for a nominal 10-year note to be somewhere between 5 and 6%. So the 3.5% we saw in a 10-year Treasury earlier this year was the wrong price.
Yeah.
The 5% that we saw in October, give or take, was more like it. And we've sort of got this battle underway in markets as to whether the Fed's done or the fiscal situation, this, that, and the other. So look, I think yields are going up. I think there's incomplete business. There is a wrong number that we're looking for. There's a wrong number out there for central bank policy. There's a wrong number out there for real yields, which are very important. And there's a wrong number out there for bond yields at which people just say, I've had enough. We haven't found it yet. We still haven't found it.
But if we've got a 10-year at that level and a 30-year...
let's say 6 or 6.5, some high number.
Yeah. So call it 6.5.
Yeah.
Then the good news is that stocks can carry on, earnings can carry on. There's not going to be problems with credit default. So everybody's happy. But why should anybody take any risk?
The point there, isn't it, is just finance 101. If the risk-free rate, let's say the overnight risk-free rate, Fed funds is 5.25, there's your hurdle rate for everything. So if you're thinking sensibly as an investor, you're not going to extend duration for another 50 basis points in a risky investment that's only going to give you 5.75% if the overnight risk-free rate's 5.25, which is your point. Cost of capital goes up, and on we go. The best run businesses will figure out that we need to do better to incentivize people to stick with us. And that's part of this, I think it's part of buybacks and everything else. But it's a tricky one, isn't it? Because people haven't had to deal with it for a long, long time. But at the risk of being simplistic, and obviously I defer to your listeners on this, but at the risk of being simplistic, if we pencil in that the world's risk-free rate, which is a 10-year US note, is probably going to be higher on average for longer, and let's say 5.5%, then obviously in the first instance we need to be absolutely rock solid in our earnings forecasts and estimations. We need to be absolutely rock solid on understanding that particular business's balance sheet, refinancing risks and everything else. And we need to be absolutely rock solid on what kind of free cash flow yield does this business generate. So if it's 5.5% is the new hurdle rate, then we probably ought to be hunting for reasonably valued businesses that generate a free cash flow yield comfortably above that. And as you and I know, that's a bit awkward because the sector of the market that offers that is the one that people can't really touch.
Yeah, I mean, it's quite funny that you say that. But we'll come back to what to look for in equities. Because I'm curious about the buyers of the bonds. So one of the big buyers of the bonds has been the Chinese. They're probably not going to be big buyers of the bonds going forward for other reasons. The other big buyer has been the Japanese.
Yeah.
And I know you've got interesting views in Japan. And I'm not sure if I've got enough money in Japan. But if the Japanese are going to be completely changing strategy and putting rates up, will Mrs. Watanabe go into the equity market?
That's the general idea of what they're trying to do. It started under the late Prime Minister Abe, and the thrust of it is make Japan great again. And I tip my hat to a hardcore group of equity investors who figured out 5 years ago that there was a long-term structural Japan re-rating afoot. Japan is moving away from Japanese-style shareholder capitalism. Notice I didn't say activism, I said capitalism. In other words, they didn't give a hoot about the shareholders. You had all the Keiretsu and Saibats and the cross-holdings. It was terribly inefficient. And Abe sought to rectify that. And the current Prime Minister, who is deeply unpopular, Kishida-san, is trying to accelerate that to finish the task. It's very impressive. But it's one part of a broad Japanese strategy, frankly, to make Japan great again. And the thing that they're most nervous about is Taiwan, and maybe we'll come to that later, but it's a complicated area. But look, fair play to some of the world's largest active equity managers for figuring out that not only was there deep value in Japan, which has been the case forever, but there was actually a catalyst for change.
Yeah.
I mean, when was the last time we heard MBO and Japanese equities in a sentence? We've had another big management buyout in Japan this morning. A management buyout in Japan? What the heck's going on? And it goes back to our broad point about keeping an open mind, whether about interest rates, about the Fed, about plumbing. We have to keep an open mind here if we're going to succeed. And of course, there's more long-term capital coming into Japanese equities. Of course, the valuations are still compelling. Of course, there's years of this to play out. But make Japan great again is an investable theme that is likely to be with us for a long time. And you've just actually, I keep saying sidebar, but just a sidebar here. You know, people go on and on and on about Jeff Bezos, and rightly so. And they look at all his sayings and phrases as this giant visionary, which of course he is. But one of the things he likes to talk about is that people, all of us in markets, in business, tend to focus on what is changing. And Amazon is built on the back of what is not changing. And I think that's good thinking for investors to keep in mind as well. We are caught up in the day-to-day. We're arguing over the next 10 basis points in inflation. We're arguing over this, that, and the other. We get caught up in the noise. And you have to fight really hard to think about what's not changing here. And in the case of Japan, there is this run, I don't know the words runway, but there's something happening in Japan that no matter, well, I'll say, no matter what's happening in other parts of the world, Japan is now determined to finish this job of making Japan great again. So it's not just the shareholder activism or a more shareholder-friendly environment, which is obvious, I think, to most people today. That will attract more and more of the world's sticky capital. In parallel with that, you've got a central bank that is poorly understood. People know that they're liberating Japanese government bonds. That's happening. We can see that. And of course, Steve, as all your listeners know, if the world's lowest yield curve is suddenly being liberated and Bank of Japan JGB purchases held down global bond yields everywhere, then the spillovers from higher JGB yields are likely to be profound and add to the pressure on US Treasuries and everything else. But there's a missing ingredient here. The market knows that it's absurd for the Bank of Japan to have still negative interest rate policy when you have inflation ticking up again, as we saw earlier today in Tokyo. So the market knows that the Bank of Japan is going to do away with negative interest rate policy. And a lot of people say, yeah, big deal, -10 to 0, who cares? Well, it's a lot bigger than that, because what they're actually planning, can you believe policy rate normalization and Japan in a sentence? You know, that's what's happening.
Yeah,
they're going to take rates not from -10 to 0, but to a much, much higher number. And I don't think people are prepared for that. Now, of course, the doomsayers would say, oh my gosh, Japanese interest rates going up, really bad for JGBs, usual tinfoil hat stuff. It depends. We all know that Japan is a nation of savers. What does it do for Japanese household income if instead of getting 0 on all their cash balances, they start to get a non-zero number, right? There's a whole lot of things happening here. But then to get to your important point, which is global capital flows, Japan has been the anchor investor in credit and bond markets worldwide, but US credit markets in particular. So not just treasuries, which is well known, right? CLOs, structured credit, high yield, investment grade. They are the anchor tenant, if you will, of all those markets. Now, I want to be very clear. I'm not saying for a second that, for example, Norinchukin, which is Japan's central bank for agricultural cooperatives, I'm not saying that they're about to redeem all the CLOs that they own in the United States, in which, to be fair, they've never lost a cent on. I'm not saying they're just saying, hey, we're out when they own 70 billion of AAA CLOs. It's not that. But the incentives are changing at the margin. And if we get to the point where the Norinchukins and other gigantic pools of Japanese savings actually feel it makes more sense to put the marginal yen we have into yen credit or longer term JGBs, then it's a marginal yen that's not going into US credit and other markets around the world. Now, that's not instantaneous, but again, it's a process that is starting now.
But this could be a staggering effect because the yen's 150, and so they can only lose money. They've made a lot of money out of the currency because the dollars are worth a lot more yen, and the yen's very, very cheap. So if you were the treasurer of one of these banks, you'd be saying, "Well, hang on a second, and get more interest on my yen at home, and I don't have the FX risk." So you'd be bound to repatriate a huge amount of money, wouldn't you? Well, and that could be a huge, huge headwind for credit markets everywhere.
Yeah, and it could be, and it should be, but the timing of it is uncertain. The last thing that Japanese investors want to do is rock the boat. But if we extrapolate this to a sort of a negative outcome, look, we all know that Japan has an awful lot of JGBs. There's a lot of domestic holders of JGBs. If JGB yields go up, everyone says it's really bad. It's bad for the Bank of Japan. It's bad for Japan Post Bank. It's bad because of the losses on the balance sheet, right? Okay, fine. People forget one important thing, which is Japan's net international investment position. If the whole, this is a big if, it's a hypothetical, but if the losses on domestic assets are big enough because JGB yields go up a lot, well, the way to address that is to sell your foreign assets to fill the hole.
Yeah.
And, that's something that's on my mind before you think of the organic incentives of putting more money to work at home rather than expensively overseas when you factor in currency hedging and everything else. But the whole point here is this: something really important is happening in Japan. Really important. And again, equity, let's call them the equity vigilantes, figured it out a long time ago. Some of the biggest private equity profits on earth have been generated in Japan.
Oh, really?
Yeah. And they don't like to advertise that. But one or two of them got in there very early and have done phenomenally well out of these restructuring transactions with the full blessing of the Japanese government.
Of course, we've been able to buy assets cheaply, so that's
yeah.
But it seems obvious that what we should be doing is we should be paying a lot more attention to Japan. It's going to become a lot more important. The equity market could be really good market if these reforms take hold. I wasn't even aware of them until, was it this year? I went to Polar Capital did an investor day, and I sat listening to the Japanese guy, and he came out with these reforms. I thought, well, why did I not know this? But
look, I think to be fair, we've all been able to eyeball all sorts of Japanese listed businesses for 20 and maybe 30 years. The net cash businesses, you go down this, and just been sitting there, and it's been one of the world's biggest value traps until Abe said, I'm going to fix this. And now Kishida is saying, we will finish the job. So you finally got a catalyst for change where all of the Japanese government, bipartisan, regulators and everything else, and even the Tokyo Stock Exchange, and I'm paraphrasing Neil, saying, if you don't do something to improve your shareholder returns, we're going to delist you. Well, there's an incentive. So finally, we've got a catalyst, and that's different. And there's this phrase I like to use, as some of my clients who are probably listening know, which is beware the stable variable, right? So let's think about the past 20 years. US house prices cannot go down. Really? Well, if you've built a whole financial ecosystem on that assumption, and it turns out they can go down, we've got a problem. There can be no inflation. Really? Well, look at the past 2 to 3 years. Guess what? Oh, we cannot do direct fiscal transfers to households and businesses. Really? Oh, Japanese interest rates can never go up. Are we sure about that? So these things are changing. And again, the challenge for all of us amidst these changes is to be proportionate and to be sensible. Because there'll be any number of people saying this might break, this, that phrase people use, oh, something will break. What does that mean? That's just a cop-out. But we need to keep these changes in perspective. Some people will say, oh, it's bad. Well, I prefer to say it's different. And if we have the skills to evaluate these great assets and we're comfortable with those valuations, we should own them. Simple as that.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information.
Okay, well, let's fly down from Japan to Australia. Who was the bank? Was it Commonwealth Bank? It's a big one. They're now allowing people to borrow 95% of a property's value. I mean, what planet are these people on?
Well, I'm not sure, and I'm one of them. I'm not borrowing a 95% LTV, I'll just clarify that. But look, a lot of people view Australia as some kind of levered commodity play, and there's lots of reasons for thinking that. It isn't. It's a levered house. Everything is about housing. The incentives have been building for a long, long time. There's the tax incentive of negative gearing on investment property. You can deduct the interest on debt. So is it surprising that a lot of people's first home, in inverted commas, is actually not one they live in, it's one they rent out? So they get on the property ladder by buying an investment property, which strikes me as a bit arse about, but there we are. But, as Munger always says, show me the incentive, I'll show the outcome. If you have long-running tax incentives in Australia that incentivize you to build a property portfolio, you will do that. And don't care about the consequences, I will do that. So we have residential construction, we have housing, we have household wealth, we have everything, pardon the pun, geared to housing in Australia, and it's been that way for a long time. And I've been home, even after almost 25 years in London, I've been home 4 times this year, and I am gobsmacked to see where houses are transacting, houses I know well, I grew up around, to see what people are doing with property in Australia, the cost of living, everything. It's a high pressure economy. But here's the rub, and I'll answer your question on CBA. You would think, Steve, that the way to manage mortgage risk is by constantly monitoring defaults, prepayments, this, that, and the other, household incomes. And to be fair, the Australian banks do that as well. But we have a mortgage market dominated by 4 institutions. And the way they manage mortgage risk, and I say this tongue in cheek, is by ensuring that they never lose market share. That's what's going on. Seriously, it's about market share. When you've got 4 banks and CBA has the biggest mortgage book by far. Now, to be fair, I know people at CBA. They have some really competent people there. They have amazing data on their securitized, they really pay close attention. and their assumptions about defaults and everything else are actually really tough. That doesn't mean it's all going to be puppy dogs and rainbows, but they do actually scrutinise their mortgage book carefully. But it goes back to the incentive. What's the point of raising interest rates if you're a central bank? You are trying to slow aggregate demand to bring inflation down. And in Australia, aggregate demand is not coming down. Aggregate, not anecdotal, aggregate. And if an Australian borrower now sees the biggest mortgage provider in the country once again offering 95% LTV with some kind of teaser rate, then the median Australian borrower is not going to reduce consumption. And aggregate demand is going to stay high. And unlike the rest of the world, Australia's inflation problem now is homegrown. It's not about Ukraine, it's not about the Middle East, it's nothing. It's homegrown because it's obvious, at least to the very fine lady now running the Reserve Bank. She's just new to the job, Michelle Bullock. She said it this week. And she mentioned that it's now homegrown and there's a demand component. And that means she's going to be raising interest rates even more, as she should. I've been trying to tell my clients that all year, that the RBA is going to have to go a lot higher. And people really don't want to hear it, especially back home. So it's a very difficult 12 months ahead for Australia. But again, to be consistent, if interest rates are going up in Australia, which they have to, because underlying aggregate demand is stronger than people thought, that is not automatically the end of the world. It's difficult, it's challenging. We will see discretionary businesses in Australia are likely to have ongoing earnings misses to the surprise of nobody. But again, to be consistent, if I'm saying that the RBA has to raise rates because aggregate demand is stronger, the cycle continues. The cycle continues until eventually the RBA overdoes it. But to put some numbers on it for our listeners, the Fed has a real Fed funds rate of 2.25%, give or take. The ECB has a real depot rate, so the deposit rate adjusted for inflation, of 1.6%. And even the mighty Bank of England has a real bank rate of 60 basis points, give or take. In Australia, the real RBA cash rate, which is their policy rate, is still minus 100. It is way too loose, way too loose. Is it any wonder, Steve, that the Australian housing miracle continues to churn along, that my countrymen are out there consuming like there's no tomorrow, when the real policy rate is still minus 100? It's absurd. It is absolutely absurd.
But it will implode at some point.
Well, you worry about it, but I don't know how we define implode, but let's invert it, right? If we were trying to cook up some kind of economic or financial crisis in Australia, we'd probably seek to do it a couple of ways. Firstly, yes, obviously, the cost of refinancing an owner-occupied house or an investment property portfolio just becomes too tough. The unemployment rate goes up, so household cash flow goes down, defaults rise, everyone hunkers down simultaneously. That's the first instance. So we know it has something to do with interest rates just getting too high. But in the second instance, the reason Australia has muddled through for so long is because the lingering benefits of a positive terms of trade shock. In other words, China says, we'll have everything you got. We'll have everything you got. Dig it out, give it to us. We'll take it all forever. And what that means in simplistic terms is that if our terms of trade is rising on all our exports, etc., then aggregate national income is going to be rising as well, which will trickle down to households through businesses and everything else, which is basically what you've seen.
Yeah.
So if people say Australia's going to implode, there's two things that need to happen, I would argue. The first, interest rates get too high, households and borrowers can't cope. And in the second instance, we have to have a negative terms of trade shock. And to be frank, when you think about the energy transition, a Chinese economy that's still muddling through, you know, the odds of a negative terms of trade shock where prices of iron ore, thermal coal, we go down on this, they all collapse. seems to be fairly low probability for now.
Well, is it? But China doesn't look in great shape. The Chinese property sector, it looks a bit dodgy, doesn't it?
Yeah, let's see if we can frame this, because look, putting the plumbing hat back on, I've spent so many hours, days and weeks 10 years ago trying to understand Chinese plumbing. And you know what? It didn't matter. It just didn't matter. So yeah, there's complex moving parts, there's this, that and the other, there's blobs of liquidity that get moved around the wind, there's all of that. But it didn't matter. And the reason it didn't matter, Steve, is because there's one fundamental in China, and it's called Xi Jinping. What he says happens. So let's think about the Chinese property situation. 6 years ago, Xi Jinping announced a deleveraging campaign. And the essence of that was to make his financial system fit for purpose, because it isn't. Everyone knew that. We all thought of Chinese property as the world's greatest sustained malinvestment, because it was. It was. And most people are like, there is no way. And frankly, I was partial to this. I'm thinking to myself, this guy is trying to deflate Chinese property. Is he out of his mind? And that was 6 years ago. And he is. And he's got it wrong from time to time. But he is far from finished this campaign to make his economy, and especially his financial system, fit for purpose. You're seeing more and more headlines around Country Garden and all these other things, although this week they've provided support to 50 favourite Chinese property developers. So they're sort of, they're getting a bit uncomfortable about what's happening, and understandably so, because you can't expect above trend Chinese economic growth if the property market's stumbling, given all the revenue and associated spin-offs of that. But the point here is that I am told time and time again, to the effect, words to the effect, Xi Jinping's screwing it up. Especially from commodity companies I work with. This is terrible. My aluminium order book has fallen apart. Copper's doing this. It's like, this guy has no idea what he's doing. I'm like, dude, it's Xi Jinping. The thing you need to know about Marxists is that they're horribly consistent. Once they make up their minds about something, they keep going. They keep going. And at the 6th plenum, which is, to be a little bit cheeky, the big Communist Party barbecue held in November every year. At the 6th plenum in November 2021, Xi Jinping told his comrades, and it was not reported in English, only in Mandarin to his comrades. He gave a long, long speech in which he quoted Mao. I'm like, okay, whenever he quotes Mao, that's a big deal, right? And by the way, the time to listen to the Communist Party of China is when the system is talking to itself, not when it's talking to Bloomberg or Reuters or the FT or the Economist. That's irrelevant because it's spin and propaganda. But when the Communist Party is talking to itself, you pay attention. That's the number one rule when you think about China. So November 2021, he's quoting Mao. And he said, as Comrade Mao reminds us, ... he was talking about the US and other things, sometimes you have to ruin a nation internally in order to renew it. And that is exactly what he's doing. Now, leaving aside the geopolitics, which is very difficult, just for a sec, my point here is that it seems to me too much of the Western analysis of what's happening in China, both good and bad, is done through the prism of our experiences, which is silly. Because if we're going to understand it, somehow we need to think like him. And he's not going to spoon feed us. In fact, given the system they have, he wants to misinform us. He wants to not report statistics that are not going his way about the economy. But here's the rub. There seems to be this kind of bipolar discussion around China for many people in the West. Either A, China's going to take over the world, or B, it's having a Lehman moment. Whereas in reality, it's C, somewhere in between, muddle through, lower trend rate of growth, but it's not blowing up. It's not blowing up. Again, nominal GDP in China right now is probably around 4.5, 5. Now that's low compared to where it's been. But if we're consistent, it's really hard to have an old-fashioned financial crisis if nominal GDP is still going around 5. And frankly, in the past week or two, the Chinese authorities collectively have demonstrated more willingness than at any time this year to support the economy. Now, it's nothing like what they did in 2009, nothing like what they did in 2016. It's much more measured and proportionate, which is good, because he still hasn't finished making his financial system fit for purpose. He's deleveraging. Now, the big so what for investors, well, it's really hard, because in the recent past, and frankly, on and off for 18 months, there's been all sorts of bargains in Chinese listed equities. And if people want to have a swing at those, they can. I mean, there's some great Chinese businesses. There's no denying that, particularly when we think of these tech juggernauts. But then there's an overlay that complicates things for everyone I work with, and that's the geostrategic side of it and the geopolitics. It's really hard. And you, as I've reminded people, my clients for 5 years now, you could be the world's greatest analyst. I'll try that again. You could be the world's greatest analyst of an Alibaba, JD, a Tencent. You know, we can go down the list. That's great. You could get earnings to the dot. You could understand the balance sheet. You could even go...
No, you couldn't do that.
Oh, no, I know that's... Yeah. You could get comfortable with a Cayman's prospectus, you know, all that kind of stuff. You could get comfortable, but you're missing the point, because there is one super senior investor. His name is Xi Jinping. He doesn't care about you. He doesn't care about your fund. He doesn't care about your NAV. He doesn't care. All of these things are pawns in his game. And it surprises me that amidst the discussion of valuations of various Chinese businesses, nobody sort of discusses the Communist Party representation at the highest levels of all these companies. And I know this sounds harsh, but I have many reasons for believing it. Every Chinese business is now a state-owned enterprise.
It's funny because there are a few well-regarded, highly respected investors starting to buy Alibaba in the last round of 13Fs. And I was thinking, because we've got the election in Taiwan in January, and kind of that seems a big existential sort of kind of risk.
It does. And look, to be fair, there will be a number of people listening to us saying, oh, you know, you've gone a bit Trumpian, this, that, and the other. No, I'm just describing the world we're in.
Yeah, no, sure.
And it's a serious situation. And let's think about that. Let's just segue a little bit into Taiwan. So we had an APEC summit, a leaders summit in San Francisco, where on the surface it looks like Xi and Biden and many others tried to hug it out and de-escalate it. Good. That is good news. If we're finding a way to talk to each other, and most critically of all, resume military conversations that have been in abeyance for 2 to 3 years, that's not good. That's not good. So we're now talking to each other at senior military. Good. So we have back channels where we can de-escalate and understand each other, and we didn't have them until recently. That's an improvement. But the spin coming out of it was that there's a de-escalation on all sorts of things. Taiwan's on the back burner. Everything's just going to simmer down. And you may have seen over the past 3 weeks, there was a lot of excitement about Taiwan because the two main opposition parties appeared to be forming a coalition against the incumbent government. So the incumbent government, or the likely winner of the election in January 24, is not pro-independence per se, right? Or not against, it's hard to define it, but let's just say they're not in Xi Jinping's good books. But the two opposition parties getting together caused a huge amount of excitement, because if they could figure out a deal, they would very likely win and be much more pro-Beijing. Now, we've seen this morning that coalition has fallen apart in one of the most farcical political moments that could only possibly happen in Taiwan. It was absolute farce. That's not going to please Xi Jinping. And there's ample evidence that Xi Jinping sought to put this coalition together, right? These two opposition parties, coalition, pro-Beijing, and then here's the rub. What the press missed from this APEC meeting, which bothered me a lot, is that Xi Jinping actually upped the stakes on Taiwan. He didn't de-escalate. If you read everything that was discussed, he did not de-escalate, although people are desperate to believe it. He actually upped the ante by saying to Biden on the record that you must agree you must abide by any peaceful reunification of Taiwan. In other words, if our preferred candidates win, you just need to let them give it back to us. Now that's a big problem, because I don't think in an election year, a presidential election year, an enfeebled president, which unfortunately he is able to stand there if Xi Jinping by some way is able to get Taiwan back peacefully. So markets are very badly misunderstanding what's going on. On the surface, it looks like things are settling down, but when you do a bit of digging, Xi Jinping has upped the stakes. And the working assumption seemed to be that if I can smash together this opposition party, a coalition, win a democratic election, then there's nothing that all these democracies in the West can do if the people of Taiwan have voted. But now, if the election is status quo, the current vice president wins in January, I think Xi Jinping is going to be pretty cheesed off. And the reason I flagged that, and wasn't reported around APEC, the incursions that are going on every day, right now, even today, into Taiwan airspace, sea space, and everything else, off the charts. We've never seen anything like it. And that bothers me. And look, to be fair, it's very difficult for those of us in markets and very difficult for investors to adequately handicap geopolitical risk.
Yeah, it's really hard.
It's really hard to do. And I'm not suggesting for a moment that anyone listening incorporate Taiwan nervousness into a portfolio. Oh, I've got to do this in the Taiwan dollar, or TSMC, this. I'm not saying that. I'm just saying we need to keep it firmly in mind. We need to investigate. We need to read, because this is not a de-escalation. It's an escalation.
So January is the...
January is where it gets a bit lively. And my strong suspicion would be that Xi Jinping will be seriously displeased if it's a status quo election.
To go back to where we started, we don't really have time to go all the way around the world.
Yeah.
But just going back to where we started, we were sort of saying interest rates going to be higher. And I just wondered what your views were, because everywhere I look, there's just a lot of leverage. I mean,
good point.
so, whether it's the basis trade, and you sent me something that there was that, I don't know, it was a central banker said there was 500 billion of trade supported by $10 billion of hedge fund capital. I was listening to Patrick O'Shaughnessy's podcast, and he had this guy on that was, I think, Walleye Capital, CIO Walleye Capital, based in Minneapolis. And he was talking about what a good business multi-strategy hedge funds were. And they, we reduced the risk right down, and then we juice it up with 10 times leverage. I mean, I just don't get this. I mean, all this leverage everywhere. If money costs more, these guys can't make money doing that, can they?
Well, they can, because they are, and the bets are enormous. And what we're talking about is, in this specific instance, we're talking about sophisticated, highly leveraged, relative value fixed income folk taking advantage of the discretionary between treasury futures and an underlying treasury bond that you can deliver into the futures contract. So they're trying to harvest 6 to 7 basis points, give or take. And if you're going to generate superior returns out of a 6 to 7 basis point, let's call it anomaly or opportunity, then of course you're going to have to use a lot of leverage. It's a trade that people have done for decades. It's just that it caused a bit of problem in March 2020, and it's grown in size. But of course, given what happened in March 2020, if these guys are going to put on the risk again, then they've had to go through the internal compliance meat grinder. They had to go through all sorts of checks and balances to put the trade on. But so much of financial regulation is not preemptive. It's financial archaeology. It's solving for the previous crisis, saying, oh, this is what happened. Must not let that happen again. Okay, that's cool. The good news, just to extend this conversation, the good news is for the regulated banking system, particularly the biggest banks, it's almost impossible to replicate Lehman, although Credit Suisse had a jolly good go at it, right? It's almost impossible to replicate Lehman. So we've got more capital, a little bit less leverage on the regulated banks. There's more regulation pending from the Fed on liquidity buffers and everything else. So we've got more liquidity, loss absorbing capital, ... Great news. But as you know, Steve, and as our listeners know, risk is never extinguished in finance. It just gets moved around. And the risks that once would have been held on regulated bank balance sheets, guess what? It's now all across non-bank financial institutions. Now, frankly, I'm less worried about hedge funds that are doing this basis trade than I am. I mean, if some of them get unfortunately chinned, that's life. I'm less worried about this basis trade that regulators are in a tizzy about than I am about all this other long duration illiquid stuff, private credit, private debt, private equity, and most of all, the people that have allocated to it. There's nothing wrong with private debt, privates in general. There's nothing wrong with taking illiquidity risk. But of course, so keen were people to keep up with the game in 2020 and 2021, they thought they were harvesting the famous illiquidity premium, right? Buying cheaply, being compensated adequately for taking long duration liquid exposure. But they didn't. They were so keen to play that they paid an illiquidity discount. And the attraction was not the illiquid asset. You know I was going to go with this. The attraction was that this stuff, all of it, was apparently non-mark to market. Or it could only ever go up. Now, for about 18 months, that was true. It was true. Everything went up, including some absolute garbage businesses, because it could. Right? If interest rates are going to be zero forever, who cares about operating earnings? We just sit and wait for it. It's party on. All those parabolic charts. But then if interest rates go up and all these illiquid businesses still can't generate positive free cash flow and everything else, then they're zeros. And that's the reckoning that's ahead of us. But the attraction, I fear, of so much of this illiquid exposure was the fact that it was no mark-to-market risk, zero vol. And Steve, if you and I could stuff our portfolio with a whole bunch of stuff that we're confident is zero volatility, then obviously it reduces our overall portfolio volatility. So we look really clever. And over the next year or two, we're going to see the other side of that. Now, to be clear, it's rational for people to say, oh, geez, what does a recession, which will come at some point, what does a recession mean for all this private illiquid stuff? Well, guess what? It's probably going to be challenged. Oh, what does it mean for the people who manage these private XYZ portfolios? Well, it might be a few headline risks. But the real problem is actually not the managers. The real problem is the people that hurled money into these strategies, the end investor that thought, I must do this. And as of now, in late 2023, in a difficult world, there's all these large asset allocators all around the world who are really starting to chafe with their liquid exposure, and there's not much they can do about it. And, we didn't talk about it, but LDI was an early example of how people got liquidity and operational risk completely wrong, hopelessly wrong. And I don't think any of us should be surprised if we start to see more of that sort of stuff with asset allocators, some of the world's biggest pension funds, I'm thinking of California, of course, start to get into a bit of trouble with their liquid exposure. In fact, we'd be more surprised if they didn't.
Well, I think it's guaranteed. I thought the Californian investment in the Blackstone E-REIT.
The Regents seemed to get a great deal, but I'll just say diplomatically, there seemed to be an awful lot more to it than the headline
I mean,
announcement.
it's a classic one. Now, on your website, you say you have gifted 2,700 books. Now,
Yes.
I hope you've got an Amazon affiliates account, because
Yes.
that's a big thing. What's the most popular one? What's the one you've most given away? And why do you give away so many books?
I've always liked books. I've always liked reading. And as you and I know from working with some immensely impressive investors over a long period of time, the most precious asset in their portfolio is not a stock or a bond or Amazon or Nvidia or whatever. It's time. It's time. Time to think, time to read, time to reflect. And one of the beauties of your podcast is it helps people do exactly that. And in a world that's shouting at itself all day long, most of my clients, and they've got diversity, inclusion training, they've got compliance training, they've got to do marketing, they've got to do this, that, and the other. Okay, that's part of the territory. It goes with the job. But they've got less and less time to be still, to think, and to reflect. And you're never going to outperform if you're always on the back foot.
Sure.
Reacting to a text or reacting to a colleague on the trading desk saying, boss, have you seen this? You're never going to outperform. And I thought when I started the business, what might I be able to do differently from a branding perspective, and also to encourage my clients as best I could to just stop and decouple and to think, hence the books. So I sent my first book list 13 years ago, and it really resonated with my clients. I sent my last one out about a month and a half ago, and I'm still 95% processed, so if there's any clients listening, I'm getting there. But it's now closer to 3,000 books, and I compile a list every year. You know what it's like. People say, oh, I'm reading this, that, and the other. I thought, well, I'm going to be a bit more forceful than that. I'm actually going to send my clients books. They choose. I send them a whole array of books on not just finance and economics, in fact, especially not finance and economics, but all sorts of things, history, geography, music, sport, whatever, just to encourage them to read. And it's been a huge success. I don't know why more people don't do it. I suppose it's the cost, because it is a cost, but that's okay. So it's twofold for me. It's encouraging my clients to have the courage to step back, to read and to think, and also to thank them. Thank them for supporting me for almost 15 years. But if we're trying to be less wrong, which is another one of those phrases I like to use, if we're trying to be less wrong, we have to be able to decouple and to unplug. And it's the hardest thing, Steve, for our mutual friends to do, managing these large portfolios, just to create that space. It's a constant battle. Arguably, it's a first world problem when you're managing many, many billions of dollars or tens of billions of dollars. Oh gosh, you have to do another marketing pitch. Well, you're not going to get much sympathy, but it's an important point. So the books are an important part of that. I tried to read all the time.
How many books do you read a year?
Last year it was 74, and this year it's 60 so far. But look, it's great to keep score, but the point here for listeners is not to say, oh, you should feel bad if you read 3 or 4 books a year. It's not that at all. It's not the quantity or volume of books that you read. It's what you take away from them. And you should never be afraid, and this happens to me frequently. A book is recommended to me, or I read about it, and I say, okay, I'm just not feeling it. I give every book 100 pages, and if I'm not getting it or feeling it 100 pages, I'm done with it. Life's too short. But it's the cheapest education we can buy.
I absolutely agree.
The number of unbelievable books I've read that cost me £5 to £10 or $5 to $10 on Amazon or Abbey Books or whatever. Just incredibly insightful books. I read in large part of the function of some of the people I connect with around the world. I spend a lot of time reading about intelligence analysis. not output per se on various geopolitical issues, although that's important. But some of the best books I've read are on intelligence analysis. I mean, for example, I did not know that JFK, who died was assassinated 60 years ago this week, I did not know he recorded all his deliberations in the White House over the Cuban Missile Crisis. There are transcripts. And a book was published years ago, and we think, there's this tendency to think of JFK as a bit of a philanderer, well, to say the least, he was. And a bit of a naughty boy, and his father was corrupt as heck. That's all true. But to see this young man under enormous pressure, he was 45 years old, we forget that. 45 years old with all these inputs, some of them like Curtis LeMay, who wanted to bomb the entire world to pieces, listening to all of this. And the thing you take away from these tapes, and of course he was badly scarred by the Bay of Pigs invasion, right? So he learned from that and he improved, which is impressive. But the transcripts of Kennedy dealing with the Cuban Missile Crisis are absolutely extraordinary. There is a man under pressure because if he makes a mistake, the world ends. And with his brother and other key advisors, the thing you take away is how far ahead of all of them he was in understanding Khrushchev's incentives and in understanding that Khrushchev knew instantly he had massively overstepped, and finding a way eventually, when everyone's saying bomb the crap out of this, that and the other, finding a way eventually to give Khrushchev a way to back down. It's extraordinary. And you think, how do I apply that to understanding the world today or understanding the pressure that our leaders are under? So I spend a lot of time reading books like that. Graham Allison, will there be war with China, this, that and the other, Thucydides' trap and so forth. And Graham Allison's a doom monger on China. No. One of Graham Allison's earliest books was on the Cuban Missile Crisis and decision-making under pressure. And frankly, decision-making under pressure is what all of us in finance do every day. So just things like that. Actually, come to think of it, would it be useful for you and your listeners if I put together a short list?
That'd be fantastic.
Would that be useful?
We'll stick it on the webpage.
Yeah. Why don't we do that? Very happy to do it. So look, books are absolutely essential to what I do. I read because I can. I read because I must, and whether it be to educate clients or to help me be less wrong, there's no excuse.
Listen, it's been I've really enjoyed talking to you, and it's funny because we've never met before, so this is the first time we've had a conversation.
Yeah.
And I would laugh because I haven't asked you the question. You've got a brilliant turn of phrase, and you said the two best answers are "it depends" and "I don't know."
Yeah.
And he said, you said, if in doubt, don't listen to me. And I was going to ask you, how do you have any clients left? But it's obvious. It's obvious why you've got a brilliant client roster.
Yeah.
I am incredibly grateful to you for allowing me to have this conversation. I know you get asked to go on a lot of podcasts. I feel privileged to be one of the three you've come on.
Well,
thank you so much.
Well, it's my pleasure, Stephen. Thank you for your time this morning. It's great to meet you as well, and keep up the great work. We all appreciate it. Thank you.
Cheers.
Well, someone who's produced a book list of 2,700 books is always going to be well read. But wow, James' expertise in China, Japan and Taiwan seemed really remarkable to me. If you're an institutional investor, you better get in touch with Aitken Advisors. I don't see how you can afford not to have his Notes from a Small Island in your inbox. And how happy am I? James used to work with John Clemo and Andy Lees at UBS, and back in the day, I really enjoyed John's emails, and now finally I got the chance to meet James. I just want to say thank you to all you listeners. I am so enjoying doing this podcast and having the opportunity to talk to people like James. This is such a fun project for me. I hope you enjoy it half as much as I do. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes. and lots of other videos which can help you on your investing journey. Thank you for watching.